So the reason you got the exercise of time value of money, as I mentioned earlier, key to understand bonds is to understand the time value of money concept, present value, future value concept. Okay. But before I start, let me just to give you an overview. So where are we right now in conjunction with this chapter? Where are we? I mean, before we tackle the individual tree, we have to know big picture where we are in the forest when you're hiking, right? So we finished chapter 13 and 14. What does that mean? We call that equity financing. It's all about corporation raising capital, right? So how do we raise capital in chapter 13 and 14? By issuing common stock, preferred stock, all that kind of stuff. Shares. Share represent ownership of a corporation. So now we are introducing another pathway, another possible pathway to meet the needs. What corporation needs cash for whatever reason, expansion of business or growing the corporation. So let me put this in a perspective. Since we are in accounting class, everybody knows accounting equation: assets equal to liability plus owner's equity. But in this course, we call that she. Who is she? Shareholders' equity. Remember, I've been saying this all along, chapter 13. She has two pockets. What's the one pocket? Paid in capital pocket. The other one is retained earnings pocket. Here's the earned capital. Here is paid in capital, paid by corporation shareholders. That's chapter 13 and 14. We already covered that. Then while we are talking about this area, bond, all right? So I hope nobody say bond. Don't say, who is bond? Right? So today's agenda is, what is bond? What are bonds? And why? And then next session I might go through bonds basic, all those nitty-gritty nuts and bolts of bonds. But it's a really important concept, especially for 1B and all the way to MBA. Why bond? Why bond? But first of all, what are bonds? Rather than who is Bond. We are not talking about James Bond or we are not talking about Barry Bond. And we are at the same time, oh yeah, this happened before. We are not talking about bail bond for legal system getting out of the prison. Remember that IMF guy? Remember the French guy, International Monetary Fund chairman? He just spent what, $1 million cash, $5 million bond to get out of the jail in New York City. Remember in Hotel Sophia? Anyway, so the same word of bond. So please do not confuse. So in this picture, accounting case, where's the bonds belongs to? Right here, liability section. Liability section. We've been talking about equity section, right? So therefore, this is called equity financing. How about that? Equity financing. Here, under the liability, what's liability? In my accounting, 1A course, other people's money, OPM, other people's money. In here, we are talking about debt financing. So two pathways of financing possibility. Okay. Why? With that much, why? So before I go to why, so can I say bonds are pretty much written promise, right? Written promise. Here's the bond certificate. Promised by who? Issuing corporation. Who are these? Who are people buying these bonds? We call them bonds holder. They purchase bond. In chapter 13 and 14, people who purchase our share stocks, we say shareholders, right? We are the issuing corporation. So bond issuer, bond holder. Bond issuer is the corporation. Bond holder is bondholders are the investors, so to speak. So they so in terms of accounting equation, this issuing bonds will show under the liability, debt financing versus equity financing, right? So debt financing, equity financing, better known as a stock. Over here, equity financing, debt financing is the bonds. So with that much, understanding of bonds, let's talk about pros and cons of issuing stocks versus a bond from a corporation's perspective. Why a corporation? They do have both. A corporation comes to my mind is a Ford Motor Company. About 15 years ago, they issued $8 billion bonds offering, as well as they do have stocks, right? Ford Motor Company stock, right? Stock symbol F, one letter F. That's the Ford Motor Company, New York Stock Exchange, New York Bonds Exchange. So just capital market. Okay. But what I'm saying is, I happen to use a Ford Motor Company, but a corporation, like a lot of many Silicon Valley corporations, small e-commerce startup companies, they don't have bonds. Bonds are usually for established corporations. They only have stocks, right? Usually NASDAQ, because it's not a big corporation. Let's think about the pros and cons. Your textbook also talk about the pros and cons at the beginning of PowerPoint slide, right? Right. Advantage of overcommon stock. Stockholders' control is not affected. Right? Issuing bonds means we are not issuing for additional owners, am I right? Because it's on the liability section. Equity area, when you're issuing shares, stocks, you are selling part of you. You are selling the control of the corporation. Control I'm talking about. So bonds, it does not, right? And the tax saving result, why tax saving? Because the bonds, you have to pay back interest and principal. So interest is expense. Interest expense. Remember chapter 14, dividend? Dividend is not an expense. I know dividend is something the corporation pay back to shareholders. We talked about that. But that's not an expense. That's a return of capital as token of thank you, token of appreciation to shareholders. Here, interest, bonds, okay, so, well, speaking of that, I forgot to mention this. So, relationship, let's establish a relationship when we talk about interest payment. So, we're going to call bondholders, from our perspective, we're going to call them creditor. Then we become debtor. Can I say that? We corporation. Over here, we are corporation managers, corporation fiduciary duty officers. Who are the other side? Who gave us money, paid in capital? They are shareholders. But here, the bonds, debt financing, using bonds as a financial instrument, they are the creditors. They are not owners. They are outsiders. So therefore, they will be happy as long as they get paid back their principal back someday, right? If it's a 20-year bonds, 20 years from now, they're going to get principal back. That's the maturity date. And then in the meantime, they are get paid what interest payment from the corporation. So as long as they got the two things, interest and principal paid, they will not say anything to you. They don't try to control you. They don't have a percentage of ownership. As opposed to chapter 13 and 14, the more you issue the share, the less control. So that's why your textbook talk about tax saving result as opposed to stock. Stock dividend cannot be an expense. It's not tax deductible. Therefore, you have to pay higher tax. In bonds, because of interest expense, periodic interest expense, your net income will be lower, net income is lower, taxable income is lower, tax liability is lower, so you can save some tax saving. This is real money. And also don't forget EPS, our old friend EPS, chapter 14, earnings per share. Remember what divided by what? Earnings divided by number of outstanding shares. Remember that? So if you choose this debt financing pathway, or not, in other words, if you choose to meet your capital needs by issuing bonds, not stock, then you don't have to issue additional shares. That means you will have less number of outstanding shares. That means you will have
more control.
Lower number of denominator, the EPS earnings divided by outstanding share. Therefore, earnings per share will be higher. So those are all good things for issuing bonds, debt financing. But is it only good things? Or is there any disadvantage? Can you tell me?
You have to pay the money back.
That's right. You have to pay the cash back cash. The Lisha is probably referring to periodic interest payment. That's real cash. Usually every 6 months. And you have to pay back the principal back. As opposed to stock, remember we talked about the chapter 13, somebody invested $10,000 of his or her money into your corporation didn't do very well. So corporation belly up, declare bankruptcy, close down. Do you even have to say, I'm sorry, you gave us $10,000 2 years ago, it's all gone. You don't even have to say sorry. Nobody asked you to buy their stock anyway, right? You become owner out of own will. So, yeah, so there's a big advantage and disadvantage, right? Speaking of advantage, though, issuing stock over bonds, advantage. Answer? Ellen, advantage. Yeah, over stock, issuing over bonds.
You don't have to pay it back.
You don't have to pay back, but it's an obvious one, right? You don't have to pay back, right? Yeah. Disadvantage? How about that? Stock. Issuing stock disadvantage.
More tax.
More tax?
You lose all your money.
No. Disadvantage, from the corporation perspective, you are thinking about investor perspective, I can hear that. Right, but corporation perspective. We are talking about chapter 13, 14, 15, all from corporation perspective. A journal entry we're going to make in next session is a corporation's journal entry, not the investor's journal. That's chapter 16, investment. Anyway, so the biggest disadvantage is you are losing control. We talked about that, right? By issuing shares, you are losing control. So if you're losing more than 50% of control, they can tell you what to do. Right? So 50% magic number, we talked about that. So that's good. So those are the basic bonds. So okay, so now let's talk about this concept of financial leverage. It's a very important concept.